I guess there's three sort of general things. The first is that when you are looking forward in terms of escalation in commodity prices, you need to look forward, if that's the right phrase, to escalation in mine development costs, social rents, and operating costs. What that means is that existing producing assets are worth more than the market thinks they are. What is today a $5 billion copper porphyry development will next year be a 6, and afterwards will be a 7.2, and afterwards will be a 10. Somebody who has already spent the 5 and is in production with 30 years of reserves is worth more than people know. My experience has been that precious metals bull markets are established by gold. It's the fear buyer. And when the momentum in the gold price attracts generalist investors to the space, market leadership changes from gold to silver. This will be the 4th time in my life that this occurred. It looks like in the market that transfer is taking place as we speak. Whether or not that's true, of course, time will tell. When leadership transition does take place, silver outperforms gold pretty dramatically. And the high-quality silver stocks outperform any other extractive asset class I know. I hope you paid attention to the part where I said high quality, though. There are a lot of purported silver companies that litter the speculative landscape who unfortunately have no silver. Those can uniformly be expected to do well, too, for a little while, but they're treacherous places to be. These are truly dramatic runs. And I'm not saying it has to happen. I'm just saying that 3 times before in my life it has happened. And I'm hoping at age 72 it happens to me one more time. But let me give you a couple of arithmetic stories to warm up your audience. I came into the business in the 1970s, the most dramatic precious metals bull market in recorded history. One little silver company, then Coeur d'Alene Mines, now Coeur, started 1970 at 10 cents and ended 1981 at $65. Now, I was too young, too dumb, too poor to pay attention. But in the little rally that we had in the first part of the decade of the 90s, I helped float 2 silver companies, one Silver Standard, the other Pan American. They went from 72 cents respectively to $45, 72 cents and 50 cents respectively, to $45 or $46 in the space of 6 short years. These are truly breathtaking moves. They are not to be done with money that you had set aside for a child's college education. But they are the kind of moves that can take mad money and turn it into real money. We haven't had the type of move in the silver market that would allow the senior producers' margins to increase as dramatically as the gold producers have. The strength that we've seen in the gold market for the last 18 months has a lot to do with the fact that they're making so much money. The silver guys haven't had that happen to them yet.
They must be getting close, though, don't you think?
You bet.
Few assets can rise as explosively as silver during the right conditions. History is filled with extreme examples: tiny mining companies turning pennies into fortunes, and specialized producers multiplying in value during previous bull cycles. These moves aren't meant for conservative savings. They're built for investors willing to take calculated risks with speculative capital. Today, many legitimate silver producers still haven't benefited from the kind of price breakout gold has enjoyed. But with margins improving and demand expanding across technology, solar, and electrification industries, the setup resembles early stages of past parabolic cycles. High quality matters. Pretenders never last.
Because only about 18% of primary silver supply comes from silver mines. 82% comes from copper mines or lead mines or zinc mines. One could say, as an example with Freeport-McMoRan, that their cost to produce silver is 0 because their mining costs are paid for by copper. They just have to strip it out of the stream. The real silver producers, the Pan Americans of the world, the Fresnillos of the world, the Buenaventura's of the world, the real ones, are nominally $20 producers, but
So their margin now is almost 200%.
margin's good.
Yeah.
The margin's good.
Okay.
Now, it is likely, although not certain, that one of the ways that they got through periods of low silver prices was by producing at mine grades that were higher than the average reserve grade. That's a fancy way of saying they high graded.
Yeah.
And that will impact their results for a couple of years going forward, because it is unlikely that they haven't picked the eyes out of some of the pockets they've mined.
Ore body that they're in at the moment.
So you have to deal with that.
Yeah.
Right now, the move in the silver juniors isn't fact-based.
Yeah.
It's moved around silver in the anticipation that the stocks will do well.
Yeah.
For it to become real, the market is going to need to see a bang-up quarter out of Hecla, or a bang-up quarter out of Core, or better yet, both.
Yeah.
A bang-up quarter out of Pan American, and they're going to see that. It's important to note that most of the real silver companies are gold companies in drag. More than half of their revenues are gold, but they're still extraordinarily leveraged to silver. It's important to note, too, that while gold is not merely at nominal all-time highs, but probably in constant dollar all-time highs, silver is far from an all-time high. $57 comparing to 50 forgets the fact that 15 years has passed since the last time they were at 50. The dollar's deteriorated. As you know from earlier interviews, I love hate.
Yeah.
In 2021 and 2022, the junior silver stocks were hated.
Yeah.
I mean, truly hated. It was very clear to me at that point in time that Vizsla was going to be a mine. And nobody wanted it.
Yeah.
The consequence of that is I didn't just buy it, I bought a lot of it.
Yeah.
And so, I would suggest that in the silver names that matter to me, I've got plenty.
Most global silver doesn't come from silver mines at all. Over 80% is a byproduct of other metals like copper, lead, and zinc. That means genuine primary silver producers hold unusually high leverage when prices rise. Their costs change little, but their margins expand enormously. However, many miners have spent years surviving low silver prices by extracting their best ore first, a process known as high grading. That can reduce future grades temporarily. Investors watching the sector now are focused on whether leading producers can deliver strong quarterly results as silver prices strengthen. A single impressive report could ignite the entire sector.
I think arithmetically, no, but that depends on the individual and his or her time frame and their tenacity. I've become very patient and very tenacious, not because I don't wish for instant gratification, but because I've learned over 50 years in the markets that instant gratification is not on offer.
Right.
An investor who is prepared to stay the trade for 5 years is by no means too late.
Yeah.
Let's look at the arithmetic. 2 interviews ago, not the one in Zurich, but the one before that, we talked about the fact that I believe that over 10 years, the US dollar loses 75% of its purchasing power.
Yep.
If it does that, I would expect that gold would maintain its purchasing power, which means that over 10 years, I see gold in nominal terms between 3 and 4 times higher than today. In prior bull markets, once the crossover has occurred, once silver begins to outperform gold, the performance in silver is roughly double the price of gold. I'm not saying to you that silver is going to go 8-1. What I am saying is that a move higher in silver, from my point of view, is statistically extremely probable.
Right.
If one looks at history too, the higher quality silver juniors outperform the silver price 2-1. So if you follow that arithmetic progression, what I'm saying is that there's a possibility, if not a probability, that over 10 years, a portfolio of high quality silver juniors could give you a 20-1 return. Your investors shouldn't think in their mind, Rick Rule just said that Amalgamated Moose Pasture Silver is going to be a 20-bagger. I'm not saying that. I'm saying if you follow the arithmetic progression, that there's a very good probability that a carefully chosen portfolio of high-quality silver juniors has the potential for persistent and tenacious speculators to generate a life-changing event. Well, what I said was that I expect that gold will maintain its purchasing power.
Yeah.
If the U.S. dollar lost 75% of its purchasing power, and the dollar maintained its purchasing power, that would suggest a threefold to fourfold increase. It's simple math.
Okay, so potentially $8,000 to $12,000 gold.
Yeah.
Over a 10-year period.
I would be surprised over a 10-year period if the gold price wasn't measured in 5 as opposed to 4 digits. Markets are shaped by narrative, but investment decisions should be shaped by arithmetic. So let's look at 3 different pieces of math. The last period of major dollar instability in my lifetime was the decade of the 70s.
Yeah.
The US dollar again lost 75% of its purchasing power, and gold went up 28-fold. If you had told most people, myself included in 1970, that gold was going to go to $800 from 35, I would have accused you of smoking a then illegal substance.
Right.
You know, the second piece of arithmetic is simply that number, the deterioration of the U.S. dollar. We covered in a prior interview the debt owed by the U.S. government and the ability or the inability to service that debt. The inevitability that they inflate away
Yeah, well, they have to.
their unfunded liabilities. So, you know, those are 2 important pieces of math. The third piece of math is this. While gold is performed in a way that you and I understand, most of the investment community still can't spell gold, despite the fact that it's a 4-letter word. It is very, 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 very underowned.
Silver investors often underestimate how long major commodity cycles unfold. Economic shifts, currency erosion, and debt pressures build slowly, then suddenly reshape markets. If the US dollar continues losing purchasing power over the next decade, gold historically preserves value, and silver tends to amplify gold's performance. In previous cycles, silver doubled gold's gains once the metals diverged. High-quality silver explorers and developers can magnify those moves even further. This isn't about chasing quick wins. It's about understanding multi-year momentum. Investors willing to endure volatility, including sharp corrections, have historically captured some of the most dramatic returns in any asset class.
I think that maximum hate in lithium will occur in 2027 or 2028.
Okay.
The little increase that we've seen in the lithium price has given hope to the lithium market.
Yes.
And the market has to be hopeless for it to be hated.
Okay.
There's arithmetic around lithium, too. Most people think we had a lithium shortage, and that's why the price went up. That's wrong. We had a shortage of lithium processing capacity. In that so-called shortage, both Albemarle and SQM had 80 or 85 years of reserves. There wasn't a shortage of elemental lithium. When the price went up, people piled into the lithium market looking for lithium, and they found a lot.
Yep.
Probably 150 deposits. Maybe 5 are viable. So the investors in the other 145 have 2 more years to learn hate.
Right. Okay.
I think we've done a very good job of debottlenecking the lithium supply chain.
Yeah.
To the extent that treatment charges are falling fairly quickly. What will happen, I think, 2 years from now is that, first of all, the investment community won't segregate between 145 large projects and 5 lousy projects and 5 good ones.
Yeah.
That's what hate does. People hate lithium, so they don't segregate between good projects and bad projects. And you'll be able to buy the good projects at a bad project discount.
Yeah, well, we're seeing that with nickel right now, though, aren't we? I mean,
Absolutely.
It's
Absolutely.
incredible.
When that happens, with one caveat, if the technology around direct lithium extraction doesn't work or doesn't work well, then you're going to have a great game. I mean, a truly, truly, truly great game. You will have, as we had in uranium, as we had in silver, you will have $2 billion net present value deposits selling for 50 or 60 or $100 million. It's difficult for that. I don't understand enough about DLE technology to opine. What I do know is that some fairly advanced companies, Berkshire Hathaway, Chevron, Exxon, are working on it.
Right.
It's a strange bet for a guy like me to bet against Exxon. First of all, oil is so hated, and it's such a good business that you don't have to move too far down the quality trail to get good value.
Yeah.
You know, my life has been all about hitting the market where it wasn't. And usually information asymmetry meant that small cap companies sold at bigger discounts than big cap companies. In the oil business, that's not true.
Right.
So I've concentrated my investments on Exxon.
Okay.
Um,
Why Exxon? What?
I think Exxon is selling at about 60% of their net present value at $60 oil. Most of the industry is deferring sustaining capital investments, which doesn't affect them in 2026, 2027, but it really affects them in 2028. Exxon isn't merely maintaining sustaining capital investments. They spent $60 billion to buy Pioneer, and they're spending $25 billion to drill out Guyana.
Yeah.
So while other people are returning capital to shareholders, Exxon's doubling down.
Okay.
When I benchmark billion-dollar market cap companies, small companies that I think are attractive, against Exxon, I notice that the discount in the little companies isn't materially greater than the discount on Exxon. And with Exxon, I have almost no risk and a 3.75% dividend while I wait. It's difficult. Despite that, there are other companies that are high-quality companies that are cheaper than Exxon. So I've been buying them. I'm attracted structurally to U.S. natural gas. So I own Devon in the mid-continent, and I own Equitable in the Marcellus in the Northeast. I'm more attracted to Canada, where I face political risk. The Canadian federal government, the Laurentian elites, are biased against the best industry Canada has, which is odd, but true. So there, I want the finest companies.
The 1970s showed how extreme monetary instability can reshape precious metal prices. Few believed gold could jump from $35 to hundreds of dollars, until it did. Today's environment shares uncomfortable similarities: rising government obligations, weakening purchasing power, and widespread under-ownership of precious metals among mainstream portfolios. At the same time, other commodity markets show similar patterns of boom, bust, and opportunity. Lithium, nickel, and uranium all demonstrate how capital cycles create both disasters and legendary bargains. Once pessimism peaks, quality projects become available at prices that ignore their long-term value. The key is distinguishing real assets from speculative distractions.
I guess there's three sort of general things. The first is that when you are looking forward in terms of escalation in commodity prices, you need to look forward, if that's the right phrase, to escalation in mine development costs, social rents, and operating costs. What that means is that existing producing assets are worth more than the market thinks they are. What is today a $5 billion copper porphyry development will next year be a 6, and afterwards will be a 7.2, and afterwards will be a 10. Somebody who has already spent the 5 and is in production with 30 years of reserves is worth more than people know. They're also valued on a net present value basis, a discounted cash flow basis, which means for a company with 30 years of production, the last 20 don't figure into today's price. But that 20 years of reserves will come in awful handy 10 years from now. So I would ask people to take a look at their portfolio and incorporate more large cap, high quality companies, because the current market conditions understate the advantage that incumbent producers have. I would also urge your audience, and I'm doing this not with a knowledge of your audience, but a knowledge that comes from grading almost 100,000 portfolios over 35 years. What I've learned is that many investors get the big picture right, they get the strategy right, but they get the timing wrong. They have a 5-year strategy and they have 3-month tactics. And if your tactics are different than your strategy, you're going to lose money. In this business, you have to be very patient and you have to be very tenacious. You will have, at some point in time in this gold bull market, you will have a 20 or 25% or even 50% decline in the gold price. You will have that. Every gold bull market that I have ever participated in my life had more than one 25% decline. If you aren't psychologically and financially prepared to weather that, you can be right about gold in 10 years and still lose all your money in 3.
Yeah.
Or a risk-tolerant investor, I could pound the drum on B2.
B2, yeah.
Pound the drum.
Yeah.
The stock price has fallen by 2/3 as a consequence of Mali, which is a problem they solved, and as a consequence of Goose in Nunavut.
Yeah, but that's in production now, or going in.
That's the point.
Yeah.
You'll remember a couple of years ago, Equinox fell by half
Yep.
when they were late and over budget delivering Green Zone.
Yeah.
And when they finally got that mine turned on, when it finally started to work, bang, the stock doubled.
And that helped them get the Valentine mine, and then off they went, right? And look at them now.
It may well be 6 months before B2 shakes out.
Yeah.
But when they shake out, I suspect you're going to get the same share price performance out of Bema that you got out of Equinox. I'm not going to wait 6 months. I'm already a B2 shareholder.
Yeah, so am I, yeah.
But as we speak, I'm bid.
Yeah.
I think the uranium juniors are fully priced.
They're fully priced.
Yeah. Having said that, looking at it in 5 years, the uranium market is structurally the strongest of any resource market I know, because the juniors have the ability in uranium, unlike any other market, to lock in prices and volumes for 20 or 30 years with investment grade counterparties. Every other commodity that I know, with the exception of direct electricity, you're a slave to the spot market.
Yeah.
If you and I buy a gold stock, we can have an opinion as to where the gold price is going to be, but we're tied to the spot market for the rest of our lives.
Yep.
If, by contrast, we're in the uranium business, we can sign a contract with Tokyo Electric Power or Duke Power or Southern
Just
Company.
wait.
It'll be resolved over time.
Yeah.
I mean, for one thing, about once a quarter, people get interested in uranium.
Yeah.
50 or $100 million flows into the Sprott Physical Uranium Trust, and they go out and buy 2 million pounds. That bag of uranium is now 80 million pounds, and it's gone to supply heaven.
Yep.
The biggest single piece of uranium supply on the planet is off limits to producers, and it gets worse every year. It gets worse every quarter for the consumer.
Success in resource markets requires discipline, not luck. Investors often build a 5-year plan but act with a 3-month mindset. Commodity cycles punish impatience. Even in bull markets, gold and silver frequently decline 20–50% before marching higher. Anyone unable to withstand turbulence risks abandoning positions just before major advances begin. The most resilient opportunities lie with high-quality producers, select juniors with real assets, and sectors where long-term supply and demand favor higher prices. Whether the focus is silver, gold, energy metals, or uranium, the lesson remains unchanged. Persistent, informed, and patient investors are best positioned for life-changing outcomes.